Thanks for joining us at our new start time. It's 11 a.m. from here on out. I'm Laura Cadden. I'm with the Wealth Press editorial team. I'm joined by Francisco Bermea, who's manning the chat. Show him your face, Francisco. Don't hide. There he is.
Hey, everyone.
A handsome face it is. And today we have the band back together again. We have Jeff Zananiri, of course, Roger Scott, and any minute, Lance will join us. Is he here yet? So very excited to have everyone back.
Thank you. Glad to be back.
Yes, nice to see all your faces. We'll get started about the CPI. Came in really hot, right? Market hated the news. We saw the S&P go down 4.3%, the Dow 3.9, NASDAQ composite tumbled 5.2. Worst results since we've had since June 2020. We have better news with the PPI today. Jeff, I'm going to ask you your take.
My take on what? The PPI or the fact that the CPI is still ripping?
Any and all.
Well, the market caught off sides because there's this naive optimism, and it's nice when you're 19 years old to think that way, but everyone's hoping that inflation just goes away and that this big the Inflation Reduction Act actually works or whatever the heck. And came out yesterday, still 8.3% CPI year over year, which is massive. And core still massive. So growth stocks got whacked. The likelihood of 100 basis point rate hike next week came out of the blue and became, a not impossible scenario. And yeah, PPI came a little bit tepid this morning, but in line really. So the bad news is what they're doing so far has not worked. The market has lost faith completely in the Fed. And the belief is that what they're doing isn't working, but because it's not working, they'll probably overdo it. So we're caught in this like weird, they can't win at this point situation. And we're just on thin ice all the time with stocks. You get a 3-day rally of 5% and they give it back in half an hour. Just what it is.
Do you agree, Roger?
I have to completely agree with Jeff. We were just talking about this yesterday. Everything he says is 100 true. I don't understand, Mike. What really gets me is I don't understand why people think all of a sudden that things are just going to turn around at a snap of a button. Maybe it's because we're living in this like very fast culture where everything is instant and everything. I mean, this is the economy. Things have to work themselves out. You can't go through what we just went through in the last couple of years without some something like this happening. Just getting ourselves back on track from the COVID. Just the whole supply chain. Even forgetting the COVID impact of COVID, just the supply chain issues. These things take time, and I don't understand why people believe that the Fed is all of a sudden going to do about face. It makes no sense to me. They were very clear on their direction. They were very clear on their actions. Granted, they're way too late and they should have started this party a long time ago. But I don't understand why people are so surprised when and the sentiment changes so quickly when the Fed just keeps saying and doing exactly what they said they were going to do finally for once. So I don't understand it. I'm kind of puzzled by the whole thing. None of this really seems like a mystery to me. To me, the biggest mystery is how the market is reacting on a slightest bit of good news. When we had this rally, this 2-3 week rally,
I think, Roger, if I may, I think the market reacted the way it did because people were hopeful that peak inflation has happened, that what they're doing is working. And then this number came out yesterday and the market said, wait, none of this shit's working. These guys probably don't have a clue. So whenever you got that massive uncertainty baked back in, it isn't so much that what the Fed is going to do is a mystery. The mystery is if any of this stuff's going to work. The doubt is that they're doing that they're effective at all right now. Mm-hmm. And so we might get caught like with this double-edged sword of shit where you still have inflation high, but then you lose jobs also, and that's the worst case scenario, and that's becoming more likely.
Yeah, it's true. It's true. It's very true. And Sorry, Lance, go ahead.
Don even says in the chat, there's too much uncertainty with the administration. They're trying to sell us their stuff, to put it kindly, and that's true. If you go back over the past couple months, you know, you have the numbers, which don't lie, and then you have the administration and or the media and everything else saying, hey, inflation's coming down, prices are coming down. So it makes the perception of, hey, you know, we have the Inflation Reduction Act, gas prices are coming down, food, I guess they're saying somehow food prices are coming down, but inflation's coming down, but none of that's true. In fact, it's only going up and up and up. So it's a huge disconnect. And I know the White House said today that they're watching the stock market closely.
When did they say this?
Earlier this morning, they said they're watching the stock market.
You say it was up 0.1%, which is factually incorrect. It's not. X food and energy, it's up 0.6%. Gas came down, so that's was supposed to bring everything else down.
But it's still up
hasn't.
87% from when Biden took office.
Okay.
I don't know.
Well, I give up. That
You know, it's like something's doubled 100%, but yet numbers are good. Inflation's coming down. I don't get where the stuff is getting.
yeah.
You know,
So yeah, I think that and again, it's the reaction, and I think it's very the fact that yesterday's number, the core was higher, was a real wake up call for people to understand that sentiment hasn't changed. I mean, maybe it has a little bit, at least not getting worse, but we're definitely not seeing any light at the end of the tunnel like a lot of investors had hoped, and that means we have to stay defensive, in my opinion.
Mm-hmm. And someone just said, trade smart. What do you think the fate, what will the fates decide? What will the Fed do about the rate hike? Do you think it's going to be 1%? Do you think it's going to be 1.5? Do you guys have any feelings about that? Roger, do you want to start?
Yeah, why not? I was just reading about it right before we came on, and yesterday, you know, the days run into each other for me. So I don't know if yesterday was yesterday, it was the day before yesterday, but in the last 24, 48 hours before this whole thing happened, I think they were pricing in at 18 to 19%. Don't quote me, I may be off by 1% point. As of this morning, it's now 33%. It was this morning for sure. Somebody actually sent us a diagram. So the number is going higher, but I honestly believe that they're going to stay at 0.75 two more times, and then they're going to reevaluate to see what will happen. I don't think they're going to go to 1, but I do believe, and this is something Jeff mentioned yesterday on our call, that may be that may be the bull run that we're waiting for. That may be the catalyst that a lot more investors are now pricing in 1, and we're going to get 7.5. But I honestly think the Fed was pretty clear, and I think they're going to stay 7.5 two more times, and then I think they're going to pause and see where we are for a month or two, which would still give us enough time to get to their target by the end of the year. Remember, they said they're going to raise 3.25 by the end of the year, so that would still give us that amount of time. That's my opinion.
We're looking at 4 now, Roger. Look at the 2-year Treasury. It's at 3.75% right now.
Yeah, so it's gone. It's gone.
In 4%.
4%.
They're pricing in 4% in Fed funds before the end of the year, and 100 basis points, probably a little bit. They should have done 100 basis points 7 months ago when they first saw 0.6%, and then did 2 or 3 and got on with life. We would have had our little crash. We would have moved on. You know, people would have had confidence, but they'll do 0.75. The market will have a relief rally, and then it'll puke again a week later.
Yeah, that sounds about right.
Do you think they're right, Lance?
To be honest, I don't give a crap if the Fed does 1, 2, 3, 4, 5. They're so effed, to be honest, that they should have started raising prior to COVID. You know, to be honest, to the whole. I mean, they've been kicking the can down the road so long. They're back into a corner, and they wanted the stock market to collapse. Well, it did. Will it? Heck if I know, but trading is phenomenal lately.
Speaking of that, we have a bunch of monthly options expiring this week. Are there any highlights for you? Any interesting flow that you're seeing, Lance? let's talk trading for a minute.
Just your same horse and pony show. The Teslas, the Apples. That's what's hot today. But all the option flow is so short term. It's either September expiration or next week expiration. There's no commitment to the market, and that's what I've been trying to do with all my trades the past really few weeks. Is you can't get committed because you could love, let's say a stock like Apple in August, and then it gives it all back towards the end of the month, or you could have loved Apple last week or Monday, even when it had one of its biggest jumps it's had. And then yesterday it gave it all back and more. So, going into option expiration, everything's so short term. I mean, to be honest, you should be day trading or holding overnight, like 1 or 2 days. If you want to get committed, have fun buying expensive options because option prices are high because volatility is high. I think that's one of the worst strategies you can do is buying pricey options and holding and closing your eyes, hoping and praying that the stock's going to rally into expiration, stuff like that. But in terms of trading, I mean, you're seeing literally 20-point moves in the S&P on 5-minute candles today. And then yesterday to the downside, just 10-point moves instead of 1-point moves in the SPOOs. So I mean, if you could be quick and you can use something like my master indicator, cheap plug, day trading and short-term trading is fine going into expiration. And you also have to look at the S&P 4000. If you look at the E-mini S&P 4000, look for that magnet. I wouldn't be shocked if we have a pin at 4,000 going into SEP expiration to this Friday.
What do you think, Jeff? Do you think the short term is where we're best because of sentiment and lack of trust?
Yeah, I mean, I've been saying forever correctly that we're going to keep testing lows and it's a bear market. And so if you're investing from that point of view and you're trying to bottom pick as an investor, you're always going to get a better price if you just wait. So having cash, being short term is paramount right now. Trying to be like the most clever guy in the world and knowing exactly when the market's going to flip because the Inflation Reduction Act finally worked and we had peak inflation is one of the most foolish endeavors I've ever thought about in my life. What you got to do is be humble, have a lot of cash on the sideline, try not to blow up is the main thing right now because the market is brutality. I mean, Lance is right. The trading is amazing. And if you catch a couple of trades really good, also be humble, take your money and get the hell out of the casino because the market's going to flip on your face. Like Nucor was an amazing stock. You guys looked at that stock today? They came out and they guided down. And they said demand for steel. There's a big steel company. Stock's getting smoked down 8% today on top of what it got smoked yesterday. But for 2 weeks, it was on the top of the scanner. It's like very strong stock. Yeah. So things are flipping on a dime. Everybody's getting turned around. If you go against moves like I do, it's kind of great. But if you're a trend follower, you are going to get whipped around like Dancing with the Stars right now.
Yeah, Kramer came out Monday, said the market bottoms in, and then Tuesday Nasdaq's down 5%. I mean, how's that for, you don't, like Jeff said, you don't want to be trend following because there is no trend. The trend can get broken like that.
It's a chop shop. So things start breaking down. You can't short in the hole because you're going to get a face-ripping rally. Squeeze. You're going to get squeezed. They start trending okay. Things start feeling better. Uh-oh. They pull the trap out and then we take the elevator down. We took the escalator up. We take the elevator down. So if you can fade moves and take a little bit of pain because timing is really tough in fading and small size, I think that's the way to go about it.
Are there any stocks you're looking to bounce like in tech stocks, things like that? Jeff?
I mean, we're getting a bounce today in tech, but how long is it going to go? I don't even trust it to end the week. I don't trust it to go 3 days. I trust it to finish today out, but trying to play tech on a bounce right now this week on Wednesday after a 5%er in the NASDAQ yesterday. I don't know. I'd stay out of that. I'll stay out of that. I've been trading miners and oil pretty well. Tech has been tricky, super tricky.
Fair enough. So Roger, what do you think? Do you think the short-term trading is the way to go right now?
I think short-term trading is usually the way to go. I mean, usually short-term trading is the way to go. But again, there's a different definition of short-term trading. We have some systems that are in the market for 24 hours. We have some systems that are in the market for 2 weeks. But I think right now, anything beyond 3, 4, 5 days, unless you're hedged or you have a cluster, which we'll talk about in a little bit before we conclude this show. But I think right now you have to be extremely nimble. You shouldn't be looking for big momentum. You should be looking for reversion to the means or moves against the trend, as Jeff and Lance have both mentioned in different ways. But right now, this is not a time to be a hero. This is not a time to look for big gains. We've been, I was in a stock just the other day, and I took a profit, I don't know, 20, 30%. And I looked at it and I said, I probably could have stayed in it. I looked at the stock, it was down like 7 points. And I mean, so it's a landmine right now, and our job is to try to stay out of it. In my opinion, I would be very, very conservative right now. I wouldn't have a lot of exposure. At the same time, I am finding some stocks that are near some key support levels. I'm liking Google right now in terms of a tech stock, short term. These are all very short term plays. I like some of the utility stocks that have been beaten down yesterday. But again, I'm being very selective, being very nimble, and I expect to be in these trades for maybe 5, 6, 7 days max. So I think there are opportunities right now, but you've got to be very, very careful, and you've got to be very, very cautious with what's going on with the sectors right now.
So some of the sectors, we talked about utilities, we talked about oil, we talked about miners. Are there any other sectors you guys think are hot right now?
I'll start here. I think consumer staples is a good buy right now. I like where the number of stocks is on a 200-day and a 50-day moving average. I think they're bottoming out in the short term. But honestly, healthcare, consumer staples, utilities, and energy, those are it right now. You got to be really careful with the other sectors. Very, very nimble with the other sectors.
Somebody just asked about quad witching. Of course, it's September 16th, quadruple witching days that happen 4 times a year. Do you guys want to talk about that a bit and what impact that can have? Jeff, how about you?
So to be very, very basic and rudimentary about OPEX option expirations, there's a theory called the max pain theory, which is the stock will settle at the price where the most options will expire worthless, to be very simple. And so that is kind of pronounced. That is kind of pronounced at quad witching because it's the end of a quarter, et cetera, et cetera. And so what that means is if a stock's run up a lot and a lot of calls are in the money, you can expect those calls to get crushed right before OPEX because people are going to be burning those tickets to get to cash them in all at the same time. They all run to the window at the same time to get the cash. And if a stock's down a lot and the puts are up a lot, we don't want to be there trying to cash in on those puts at the last second either, because you will watch that stock do even more pronounced than the calls, a face ripping rally just to screw all those put holders over a little bit and take it out of the money on some of the closer to at the money expirations. So it's already a crazy ass year. There was a statistic I saw yesterday that we had 4% days in the NASDAQ from 2012 to 2019. We've had 7 in 2022. So you have a crazy ass year where we have a 5%er in the NASDAQ and people are like, ho hum, that wasn't a crash because the VIX didn't go above 30 or whatever. Still a big move. I don't like to watch, I don't know about you, but I don't like to watch long-term portfolio stocks go down 7-8% a day and call it casual. But just to give you an idea of the level of pronounced moves you will get in this type of market, is going to be even crazier on options expiration.
Why is the VIX so low given the historic market moves?
The VIX is broken. I don't
It's
know why
broken?
people look at it. VIX is the worst indicator people can look at, to be honest. I mean, and I know Jeff will probably rant about Barclays screwing the VXX, but the VIX, the VIX.
There's a lot of things broken. Look at gold future price. Try to go buy gold coins. I'm kind of one of these guys with the gun in the shed and trying to buy gold coins and shit because I'm a little bit paranoid. It's not so simple to do. They're trading at like 25%.
The markups are crazy.
Yeah, the markup's insane and there's scarcity, but yet gold futures are suppressed. Sorry, I didn't mean to interrupt you, but it's something that's been on my mind.
No, and then you got every bank in the world's got popped for manipulating gold and silver prices, which nothing ever happens. But in my opinion, no one. I know a lot of degenerates out there used to trade the UVXY. Like
Mhm.
even 3-4 years ago, people used to love it because it would move. Or even during like the whole like Robin Hood GameStop deal, like every time the market go down, they'd be like buy UVXY. But the VIX it is one of the worst instruments you can look at. Like, and to rant even more, all the basic economics, VIX inverse the S&P, yen inverse the S&P, bonds inverse, all your asset classes, everything's broken. That's the market. Like historically, if you said inflation was crazy, the market's down 20% or so this year, and you said, oh, gold is down whatever it is 20% this year, you'd be like, that's crazy. Gold should be up. The yen should be up. It's just everything's broke. So you can't really look at it. Even when we were crushed yesterday morning when the S&P was down at the open and like the first 5-15 minutes of the day, you think put buying would be crazy. So the VIX would be high because the VIX measures the price of XPX options. The VIX was up like 5% and yesterday's open. Like historically, the VIX should be up 20-25%.
Exactly. It's a big disconnect. Do you agree, Roger? Do you think it's broken?
Think that I don't want to use the word broken. I don't think it's broken. I think it's just, I think it has, I think that, here's what I think. I think investors have assimilated so much. Here's a view of it. Imagine you are a person who's dealing with a great amount of stress in your life, okay? And you're stressed, you've got whatever problems. You've got a million problems and they're constant. They're always there. That stress is going to become part of you. You're not going to really feel it that much anymore if you have it for an extended period of time. I feel that is what's happening with the VIX index. I think the volatility index has had so much thrown at it, and S&P traders have had. Remember, the function of the VIX is to measure the at-the-money S&P 500 options. If investors who are trading those options are no longer scared, then the VIX is not going to react. Okay. So I think it's what Robert just says. Traders are getting numb to some of these big moves. I mean, think about it. We've got Russia, Ukraine.
That's scary. That's scary because
I
then
know. Oh,
the market moves to make people react. So you will get bigger moves as a result of the numbness.
Sure. I'm not saying if it's good or bad or what it is, but I'm just explaining. I'm just trying to rationalize why it's happening. So basically, the market has become really immune to a lot of these stressful situations because we've seen so much goddamn stuff going on. To give you the opposite end of the coin, I don't know if you guys remember again, time gets away from me, but when we had the whole Brexit, the Brexit happened, and when Greece went bankrupt, remember that?
Yeah.
I mean, VIX made nothing was really going on in the world back then. We were in a regular bull market. Those two events caused the VIX to make all-time highs, like record highs. The spike we saw, like it went up like from 20 to 80 overnight. So if we saw then what we see now, I mean, VIX it would be out of business. So the market has had so much crap, COVID, all of these things. It's on a constant danger zone, and it's assimilating into its price. So unless there's something really unforeseeable happens, the VIX is not going to react all that much. Would I call it broken? I don't know if I would call it broken. I would call it highly desensitized, which is, I agree with Jeff. It's a very bad thing. It's not a good thing, but it's become very desensitized because of all of the wacky stuff that's been going on.
It's kind of like people at the White House throw a party for 8% instead of 8.2% CPI, right?
Yeah.
Like, it's not rational. I mean, like you lose perspective of proportionality and what normalcy is. But the problem with the market becoming complacent is that's when the worst shit happens. Complacency leads to smash. So
surprises.
That's why I'm keeping my powder super dry. That's why I have the highest percentage of cash that I've probably had as an adult right now, because I think we're going to have a scenario where you back the truck up, you max out cards, you call your Uncle Louis and you call in his marker for the bad Super Bowl bet he made. You get all that cash, and you buy it. But we ain't there yet. We ain't there yet. That's the part that's whacked. There will be that time in the next 12 to 24 months, in my opinion, where people are just so sick of the stock market that they don't even talk about it on TV anymore, because it's like, oh, like, don't ruin my day again. That's when you got to be there double fisted and having cash. If you're there now, you're probably way too early, in my opinion, with all your money in the market.
Last week, we talked about the importance of keeping emotion out of trading. And we're talking now about people being numb and really impacting the trading. How important do we think having consistent systems are for this? I know, Roger, you're a big believer in that, right? To have a system to promote your consistency, to keep this type of emotional element or non-emotional, like the numbness out of it, so that you're still actually actively trading and making money. Want to talk about that for a minute?
I think it's really, really important. Matter of fact, in my case, about half of our strategies are systematic, and we have absolutely no discretion. I couldn't make an adjustment even if I wanted to. They're completely mechanical. And again, some of them are doing great. Like I'm looking at alpha rotation right now. It's up 11% in this market environment. 3 out of 4 positions are up. 3%, 19%, 35%. We got utilities up 35%. So again, and you don't have to deal with the emotional aspect of it. The portfolio's up. There are things you can do, folks. For example, Jeff and Lance, they have strategies that are based on what's happening in the market right now. My alpha rotation strategy, we're going to be talking about it in depth today at 1 p.m. I'm going to be doing a class talking about different sectors, how to put sectors together. If I don't know if we have a link, if maybe somebody can drop a link here.
Yeah, Francisco, can we grab that? Yeah,
it is happening at 1 p.m. today. I'm going to talk about how in different market environments, you have to follow different sectors. And if you can get that right, if for example, here's a practical example. If everybody understood that during the current market environment, that the safest sectors are energy and utilities, and if you stayed there, you'd probably be a lot better off than if you were in, for example, industrial or basic material stocks. That's a huge, 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 huge thing. When the market starts moving higher again, after we have that crash that Jeff just talked about, the backing up the Brinks truck and all that, and calling Uncle Louie, I love that example. But when we do have that, even if we have that, there are different sectors that begin. For example, in a bull market, if you're in the S&P 500 versus the tech, you could be screwing yourself out of a 50% additional gain. If in this kind of market, you're in basic material versus utilities, you could be screwing yourself out of major, major volatility. So every sector, every market environment has sectors that it loves and it hates. And I'm going to be doing a real deep dive into that today at 1 p.m. I don't want anyone here missing out. The timing is perfect for it. If you guys were in this portfolio, 3 out of 4 of your positions would be up. You wouldn't even know the market is going through what it's doing if you had this portfolio. And again, one thing about hedge funds, they don't trade individual positions. You guys don't want to trade individual positions. You want to have multiple positions. When Jeff, when Lance, when myself, when we look at positions, we don't buy 3 energy stocks. We don't buy 3 semiconductor stocks. You diversify. You spread your risk a little bit. So this is going to be a great educational deep dive into all of that. I don't want to go on and on, but I put the link is up there. You guys don't want to miss out. This link will take you straight up there. So just come up there at 1 o'clock. You don't have to give any emails, anything out. Just hit that link at 1 o'clock and it'll take you to the class and it'll be a great learning experience. Make sure you bring a piece of paper or a couple of pieces of paper and a pen, and it'll be a great time. Can't wait to see everyone there.
You can just click on the link now and leave it up so you'll be ready to go at 1. So Roger, are you also going to be talking about, knocking things over at my desk. So the Fed moves that we might be having September 20th, 21st.
I'm definitely going to be talking about the Fed moves. I'm going to be talking to people about how to protect themselves for those Fed moves, how to hedge yourself for those Fed moves. I call them head moves now because they mess with my head so much. But, seriously. But, yeah, folks, you don't want to miss out. It's going to be live. You guys can ask me questions, but it's going to be really good. I've had people with PhDs in business finance come and watch these. They're like, you just summarized a 2-year class on sector correlation. This is really, really great. So you guys will love it. It's real simple. It's really clean. It's actionable, and it's what you need right now. I have a bunch of people here that are in that program, and they'll tell you it's a really great program, and it's a great program to be in right now in light of what we're seeing with the market. So you definitely want to check it out. Follow that link, and I'll see everybody there in about 90 minutes. I'm very excited for it. Very, very excited for it.
Thank you, guys. Thank you for a great show. And everybody will keep into this 11 a.m. time slot going forward. Thank you for joining us today. Have a great day. Bye.
Thanks, Jeff. Thanks, Lance. And of all, thanks, Laura. Great having you as a host. Bye, guys.
Thanks. Bye.
Thank you. Thanks, everyone. Thanks, Laura.